Here. So we have, this is like really an honor to have Joey Krug in here. He's the core developer on Augur, which is a decentralized prediction market that they're building on Ethereum. This has long been, I think, in my opinion and a lot of people's opinions, like one of the really cool potential killer apps for cryptocurrencies. Joey is a Teal fellow and dropped out of college a few years ago. He's been involved in Bitcoin and Ethereum, or Bitcoin for a very long time, and is like very into the Ethereum community. So quickly, I wanted to thank Linda for introducing us and getting him in here in the first place. But without saying too much more, take over.
Yeah, thanks for having me. So I figured we'd start off with like a really brief introduction to prediction markets. They're basically financial markets where you can speculate on essentially any event. And a lot of people associate prediction markets with just being binary markets. So like yes or no, will Donald Trump become president in 2016, things like that. But you can actually have prediction markets on scalars. So that can be like how many inches of rain will be in a certain valley, or what will the share price of Apple be at the end of next quarter. And then you can also have categorical markets. So that's like maybe a horse race or something like that. And so prediction markets are like very broad. Almost any sort of financial market is basically equivalent to a prediction market. So they go from things like the Iowa electronic markets, which is one that the University of Iowa runs, to Intrade, which like shut down a few years ago. And then you have things that people might not consider prediction markets, like the New York Stock Exchange, NASDAQ, and all you're doing is basically speculating on the future value of a company. And then you have really obscure things that are also kind of prediction markets, like onion futures or credit default swaps, where you're basically predicting, their price based on the likelihood something will default. So we're going to cover like mainly four things: what's Augur, how it works, why it's different, and what it's been like building on Ethereum. So Augur's not like a prediction market itself; it's a platform for prediction markets. So the idea is that anyone who wants to create a prediction market on anything can go to Augur, and anyone anywhere in the world can basically trade on it. So our kind of thesis here is that on-chain financial assets with no central point of failure is better than like any other use case for blockchains, is what we think. So if you remove the central points of failure, you have no one processing the trades, no one holding the money, no one person creating the markets, no one person resolving the markets. Even have like, there's no like central market makers. Anyone can come and do any of these roles on the platform. And so Augur itself has three things you can do in it. You can create markets, you can trade in them, and then you can report on them to resolve them. So market creation, it's fairly simple. You can create, a yes or no market, a multiple choice market, a scalar market with like a numerical outcome. So that's like, what will the price of a certain company be? And then you provide a description of your market, the possible outcomes, and then an end date for your question. So trading doesn't actually end at the end date. It's just like, that's like the last point of time where reporters can consider information to resolve the market. And then if you want, you can provide like a resolution source. So it's good to be specific when creating a prediction market, because you don't want something like the Bush Gore election. You don't want it to be ambiguous. You want to have very clearly defined resolution criteria. And then you can set a trading fee. So the trading fees in Augur are set by the market creators themselves. So it should go down to whatever is like the most efficient trading fee. There's no like rent-seeking behavior really. And then you can provide initial liquidity for the market, so you can seed it with bids and asks on both sides, and then you submit it. So trading, the way it works is pretty simple. It's just a standard limit order book. You can go short, you can go long, you can add liquidity by putting orders on the book. You can remove liquidity by taking them off the book. The way the fees work is it's a maker-taker fee schedule. So that's like what most exchanges use. And the only thing that's like different or unique here with trading is that shares are issued via complete sets as opposed to like just already existing. So if you think of something like Apple has shares in their company. They're traded on the NYSE or maybe they're NASDAQ. I don't actually remember. And this amount of shares stay constant unless Apple like does another offering, or if like Apple got acquired or went bankrupt or something. But with prediction markets, you have to issue the shares because they have to come from somewhere. So they're more like options markets in that sense. So the way that works is if you have a binary market, yes or no, the total value of one yes share and one no share is worth one, because that's what one of those is going to be worth at the end. So if you wanted to buy 100 complete sets in a binary market, it would cost you 100 Ether, $100, 100 Bitcoin, whatever. And then the final part is reporting and resolution. So you can actually like get your proceeds from trading at any time by like selling to someone else. But the way reporting works is, say you have a market on Donald Trump, say he wins, they would make the Donald Trump shares be worth one Ether each. And so the way we do this is we use a decentralized Oracle system. So like the most obvious way to kind of resolve markets in a prediction market, to basically say what happened, the most obvious way is to use an API. So you ping CNN if it was an election, ping Google Finance if it was a stock event. The problem is Ethereum doesn't have internet access, so you basically cannot do this. The other obvious way is to have like a central person who just does this, but we think that kind of defeats the purpose because once you have a central point of failure, then your whole system's dependent on that. And so at that point, we think you may as well just run a centralized prediction market. So the way reporting works is there's basically two halves of the reporting process. In the first half, you commit your report. So you're basically like picking like a random number, your report, and you're submitting it to the network, submitting a hash of it. And during this part, you get penalized for reporting incorrectly in the previous period. And then in the second half, you reveal your report. And this is designed so that it makes it hard to collude, because basically, if you were to try to collude with someone and like basically say, let's all say that Donald Trump won even though he didn't, the only way to provably do that would be for me to give you my salt, my random number. And if I did that, you can submit that to the network and basically steal my reputation. So the incentive to collude it, provably anyway, isn't really there. And then in the second half, you reveal your report and you get any trading fees or redistributed rep from the previous period. So this is just kind of like a comparison between like something like InTrade, which is a old centralized prediction market, and Augur. On Augur, half the fees go to the reporters, and the other half go to like market traders and market makers. The resolution is decentralized on Augur, and the penalty for central resolution on InTrade is just that they lose customers. But with Augur, you actually like lose something of value. And Augur has two backstops. So initially, people are randomly selected to report on events, but that could like go wrong. So like say you have like 10 people selected to report on an event, and they report something that didn't actually happen. The first backstop is someone posts a bond, and then everyone reports on the event. And then if that fails, the network itself can actually fork. So it's actually like once you count the forking mechanism, it's very similar to something like Bitcoin or Ethereum in the sense that you're forking the network. The only difference is you're not forking the currency, you're just forking reputation. So like the money in the markets themselves isn't forked, just the reputation itself. And then one other thing to kind of note is that like there's like two types of rep in Augur. There's like dormant rep, where you don't have to report, you don't get trading fees or anything like that. And the idea for that is it would basically be almost impossible to trade it with anyone if you didn't have something like dormant rep, due to all the like qualifications you have to do a trade when it's active. And the reason is to prevent people from doing things like reporting on something multiple times or getting more trading fees than they should, things like that. So, why would you use Augur over like a centralized prediction market? There's like a few main reasons. It's like faster, it's probably cheaper. You can have markets on anything with Augur, and you can have global liquidity for the first time. So if you look at liquidity today, it's very segregated. You have liquidity pools in the EU, in the US, and China, but it's very difficult to trade amongst them. So if I'm a Chinese person and I want to buy US equities, it's almost impossible unless I have a big institution that can help me. So we think liquidity should basically be global. So if you go to Augur, it's like the central, decentralized point where anyone can go to trade anything. And then another thing is today, creating new financial markets and financial contracts is very difficult. So if you wanted to create, say, like an exchange-traded fund, an ETF, or a mutual fund, it's going to cost you a few $1 million to do that. If you were to do the same thing on Augur, you could do it in a few minutes, and it would be, maybe $20. So the cost on Augur is going to be much lower because you're removing the people who have to store the money. You're removing the people who have to process the trades. You're removing all these people who typically, what most of they do is basically just rent-seeking behavior. They don't add a whole lot of value. So with Augur, all the fees are basically going to is boosting the security model and giving market traders incentive to actually trade markets. One of the really cool things about Augur is, I think, it'd be neat if you could ask Siri questions about the future and she'd give you a coherent response. So if you ask, Siri, what's the chances that Russia will invade a Baltic country in the next 3 years? And she said, according to Augur, it's 3.5%, something like that. And it seems very futuristic, but it's actually fairly possible. Once Augur's out, if we got Augur on Wolfram Alpha or something, it'd actually be doable. And then settlement times. So on Augur, trade is the settlement basically. So you don't have to wait 3 days to settle your trade. Once you trade something and get the money, you can trade again immediately as opposed to waiting 3 days for it to settle. So right now it takes 30 seconds if you count the commit and the reveal. But with proof of stake and payment channels, it should be less than a second. And then there's a bunch of other miscellaneous cool stuff. So on Augur, you can't do naked shorting. So to actually short an asset, you actually have to own it. High frequency trading doesn't work on Augur because it's on a blockchain and it's slow. There's no leverage or margin at the core. Everything's fully collateralized. So you actually have to own the money to trade what you're trading. You can't, pull a Deutsche Bank and have 70-something trillion in derivatives exposure without actually having to collateralize on Augur. Another thing that's neat is it's bounded. So I mentioned onion futures earlier. Onion futures are actually illegal to trade in the United States. And the reason is because, I think it was in the 50s or 60s, what happened was people just started buying a ton of onion futures, and they basically caused the price to skyrocket. And in traditional markets where you have infinite loss when shorting and infinite gain when going long, what happens is there's a dispropensity to short because, as Keynes says, markets can stay irrational longer than you can stay solvent. So there's not a huge incentive to go short. But on Augur, since the markets are bounded, you can say, well, these guys who are buying onion futures up, it's irrational for them to be doing that. There's no way they're actually worth this much. I'm going to go short. And so that's kind of neat because it's a different dynamic than what you have in existing markets. And so now I want to talk a little bit about building on Ethereum. So the first thing is Vitalik's great. When I started building on Ethereum, I asked him, I was like, it'd be great to have strings in Serpent. So we want to have market descriptions as opposed to coding them manually as integers. And he responded in an hour with a link to a GitHub commit where he just added strings to basically Serpent, which is a language on Ethereum. And then another example of this is I found a vulnerability in Serpent where, similar to the DAO thing, where if you used call.value, it would allow you to modify state where you shouldn't be able to. Serpent had this thing called send, which is supposed to be safe and not allow state modifications. But it actually did allow you to modify one storage slot, and Vitalik fixed that in 2 hours. And so it's when I started building Augur, I started building it on Bitcoin Core. I was going to make a sidechain of Bitcoin. And so our interaction with the Ethereum team has been way better in our experience. Basically, I remember talking to the Bitcoin IRC dev chat, asking them a question about Bitcoin Core, and they answered it, but then they're like, why are you asking that? I said, well, I'm building a sidechain of Bitcoin, and I want to do this. And they said something like, well, we don't want to talk about that kind of stuff here, so you shouldn't ask us questions. And so the interaction with the Ethereum dev team is just way easier, I think. In development on Ethereum, I think is at least an order of magnitude faster. When I started building on Bitcoin, it took me 30 days to add. I was adding functionality for trading, basically. I added some opcodes to it. It took me about 30 days. I did the same thing on Ethereum in less than 1 day. And then, of course, the other thing is if you're building on Ethereum, people will hate you because you're not, building on the master coin that is Bitcoin. And so you can do one of two things to deal with this. You can just ignore them, or you can also, I think it's also kind of fun to make bets with them. So I have a running bet with someone from Blockstream that he says that someone will write some Ethereum code that will escape the Ethereum virtual machine and infect a computer with a virus. within 1 year of Ethereum's launch. And so it should be like about a week now. I'll be able to collect on that because it hasn't happened yet. Some of the challenges we faced from building Augur, decentralized web-based UIs aren't really a thing. There's not really a good way to build them. And so there's good ways to build decentralized backends because we're doing that on Ethereum. But if you want to make a decentralized website, it's almost impossible. If you think about where would I store the user's private keys, you can store them client side, and coming up with ways to do that where like it's not like a terrible user experience is really difficult. You can't store them like on AWS like blockchain.info does because there's legal reasons you can't do that. And so like one common solution proposed in the community is use IPFS. IPFS is a really cool project, but it's not persistent. So if I put data on IPFS, it's not guaranteed to be there 6 months later. So for things like Augur markets, where there could be millions or hundreds of millions in volume, the data has to be there. We could have built like a desktop app, but we think like in 2016, single page web applications are going to be way more popular than desktop apps. You can't really build a mobile app because the app stores will just ban them. Another issue is like no one's built something as large as Augur on the backend stack we're using. Got a question?
I feel like I'm accumulating so many questions that like I want to ask. Like,
yeah, feel free. Yeah.
Okay. Yeah. Okay. So I mean, we had Juan Benet from IPFS in here 3 weeks ago, maybe, to talk about this a little bit. What do you see the future of decentralized apps as being on the front end side? So you mentioned IPFS is like unreliable at the moment. Is that due to a lack of scale or like something else more fundamental? And like, where do you see the future going?
I think it's due to a lack of incentives. So right now, as an IPF user, the incentive is like basically altruism. It's like, yeah, I like Augur, they're nice. Maybe I should host the market data for them. If my computer, gets struck by lightning, I don't really care that bad. I'd just be a nice person, so I'm hosting their data. But if you have economic incentive where you're paying people to host data, then I think that changes a lot. So like IPFS is working on something called like Filecoin, I think, to kind of do that. The other thing I see is, so it's like that side, which is IPFS and stuff like Filecoin would be good for like public data. So like alt market data on Augur, things like that. For data that's like stuff that only you care about or stuff that only I care about, so like my personal trade history, my private key, things like that. Like there's this project called Urbit, which is working on something that's like could be used for that. It's like a few years off, I think. But that's like currently the best thing out there for doing something like that. But it's just not there yet.
I guess like what do you see as the interface that is most likely for decentralized apps? Is it something that's hosted on IPFS and you view it in a web browser? Is it something else?
Yeah, I think it would be hosted on IPFS via the web browser. So like IPFS, like you could use it for something like hosting like the Augur UI itself. So none of the data associated with it, just the code base. Because if it goes down, if it's not persistent, it doesn't matter. Someone can put it back up because they can pull it from GitHub instantly. So it's good for stuff like that.
Cool.
And so it's another thing like building on Ethereum. There aren't really very many best practices for it yet. You're basically making it up as you go along. So like when we started, we kind of did like the lean startup MVP style thing. So you build like the minimum viable thing you need to get Augur working. So for us, that was making a reporting system where everyone could report on every event, and that's how it worked. And then we were basically like, and we'll figure out how to make it so we randomly select people to report on a subset of events later. And it turned out that like doing something like that on Ethereum ended up requiring rewriting almost all the consensus code. Basically just due to the way Ethereum works, stuff is very expensive on Ethereum. So it's not like, writing something in Java where you can write a minimum viable version and then iterate on it and add the later features you need. You really kind of have to consider where you want to end up all the way up front as opposed to iterating on it as you go on. So that's kind of like a mistake we made, I think. And then another thing we kind of screwed up there was also limit orders. So we initially had Augur using this thing called a market scoring rule, which is this thing that's really popular in academia for prediction markets, where you basically buy and sell shares through an equation. And so in theory, like the math, says that you should be able to have limit orders with these. So first we made it so all you could do is market orders. And then we decided to try to add limit orders. The problem was on Ethereum, to like issue all the shares ended up taking like hundreds of trades. So it'd take you like hours to complete a limit order trade, and it would take you like more gas costs than it would be for the actual value of the trade. That's like something like it wouldn't have really been possible to know that up front. It's just kind of something we found out as we decided to try to do it. And then another kind of big issue with Ethereum that I see today is the Ethereum wallets, like on Mist, the multi-sig wallets are very popular. Like everyone wants to use them. The problem is it's very difficult to interact with any applications on Ethereum using one of these. And the reason is because the wallets, don't automatically support all of the application interfaces. So like say you made a multi-sig wallet on Ethereum and you wanted to talk to Augur. You couldn't really do it unless you made a custom multi-sig wallet that was used to talk to Augur. So I think long term, the way that's going to work is I think you have to use something like threshold signatures, where from like Ethereum's perspective, it appears if you're just using like one private key, but really your multi-sig is like more client side as opposed to being something that's like an actual contract on chain. Otherwise, I think it's going to be almost impossible for wallets to interact with contracts. And this problem is like actually played out in practice too. If you look at like some contracts have had vulnerabilities where they try to send money to a multi-sig wallet and the wallet rejects it because it has to run a computation to accept the money and the contract didn't give it enough gas to do so. So stuff like that is like, it's very complicated. I think it's a lot easier to solve using something like threshold signatures. On security, we're like super paranoid. We think that you should write Ethereum contracts so that you should be able to recover from a hack as opposed to just trying to prevent one from happening in the first place. Because once you get, do you have a question? Oh, no. Once you get a lot of, basically a lot of volume on an Ethereum contract, the incentive for people to hack it is a lot different than when you have, a $10,000 bug bounty. And so I think the key is making it so contracts are easily updatable, as opposed to basically hoping that the Ethereum network itself will fork around you. So you don't want to, do something like the DAO where the network has to fork. You just want to be able to modify your contracts. And then there's also like a lot of talk of like functional programming for Ethereum. I love functional programming. I love ML, but what like all this top security applications use today, like things like NASA, JPL, the automobile industry, they all use procedural programming. And I'm not really exactly sure why they do it. That's what they use. It's very simple. They keep everything like stupid simple almost. So I think that's kind of a good strategy for contract development. You shouldn't try to do something very complicated. You should make it very easy to understand. And then the other thing I think is that business logic and state should be separated. So with contracts on Ethereum, there's like two main ways to write them. One is where you store all the data and all the functions that are modifying the data in the same contract. You shouldn't do that, in my opinion, because you want to be able to upgrade your contract without losing all the data. And migrating data on Ethereum is very expensive, so you should keep those two things separate.
One question. On the last slide, you said you want to make it possible to recover. What does that mean in practice? Like, how are you doing that?
So, like, I think like early on, it's very like, it's like the antithesis of what we're trying to do. But I think like having something like, a 3-day withdrawal limit. So you can't withdraw from a market until 3 days after it's done. And the reason for that is if someone discovers a vulnerability, it gives you 3 days to basically push an update to the code to fix it. Another thing I think is like long term, I think all the reporters are going to vote on updates to the code base. But I think shortly after launch, we should basically have like a multi-sig where we can just push updates to it immediately. If we did anything malicious, the network would obviously just fork around us. But I think it provides a nice balance that allows us to fix vulnerabilities as they happen, as opposed to just kind of being sitting ducks and stuck there. And then a little bit on the incentive mechanisms. Basically, with Augur, you want to make it as hard as possible to falsify a market's outcome. So the way to do that is basically to just pay people, and also to have like the reputation bond. You want it to be so that if a person reports wrongly, they lose way more money than they could ever get from like taking advantage of reporting wrongly. And so the way we kind of view it is on like blockchain stuff, if you can lower fees and it lowers the security model, that's good. But if you can make your fees lower without lowering security, that's bad. And the reason is because if your fees can go lower without lowering security, that means you're basically just rent seeking. You're not actually adding value, you're just being a middleman. But if the fees are going towards security, then it kind of disincentivizes things like, for instance, somebody can make a copycat version of Augur that charge no fees. The problem is it wouldn't be secure at all. And so that's kind of how I view that. And then the other thing you want is, as like the amount of volume and amount of money held in Augur increases, you want security to increase proportionally, or even greater than 1-to-1, as opposed to like a 1/n increase in security. And then the kind of final thing is, you want it to have like similar security properties. I think it's like the underlying chain it's on itself. It's like you don't want to build something on Ethereum that has way worse security properties than Ethereum itself. And the reason is you're kind of losing security if you do that. So like it doesn't make sense to me to build something on Ethereum that has a central point of failure on it, because you're not taking advantage of Ethereum. You're just paying money for cost and then losing it because you have a central point of failure. That's pretty much it. Feel free to ask questions.
Can you go back to the point where you were talking about the two-step resolve process?
Yeah.
Maybe like walk through an example like Donald Trump.
Okay, so say you have a market on Donald Trump. Will he win in 2016? And let's just say it's just you and me were the only reporters in Augur. So the first part of the reporting period, we're going to basically say, I say Donald Trump won, you say he didn't. And we're going to commit our reports. So what it does is it takes like your report, does this client side, it takes your report, it generates a random number, it hashes it, and then it submits it to the network. And then later on, the second part of the period will reveal that. And so it's designed to kind of limit collusion. So like, say we wanted to agree that Trump won, even though he didn't. To do that, we can do one of two things. One, I can just say, I'm voting that he won, even though he didn't. Trust me. But that's not like a very, very, there's no like honesty among thieves, I guess you could say. Now, if you wanted to provably collude with me, you would give me your salt or your random number and your report. I would check to make sure it matches the hash. If I can do that, I have one of two options. I can collude with you, do the same thing, provide you my salt and report, or I can take your salt and your report, submit them to the network, it'll match the hash, and then I'll get all your reputation. So the reason that kind of exists is since the salt is just like a random number between like 0 and 2 to the 256, it's basically impossible to guess it. So the only way I could really get it is if you gave it to me trying to collude with me. So by submitting it to the network, I can prove that you were trying to collude, and it's kind of a way to disincentivize that.
So essentially like a private key, and if you were to give it to someone else, they would be able to steal that rep.
Yeah, exactly.
Okay.
Can you still collude offline? Like they didn't share the private thing to give you the salt, but they said, let's both submit it, and we're manipulating the market or whatever, we'll share the proceeds offline.
Yeah, so you can definitely collude offline. The idea is, it's hard to find there's 3,500 reporters that we have, like right now, ready to go. It's hard to find 3,500 people who are all pseudonymous. But yeah, if like the network were just basically like two large reporting pools or something, yeah, you could collude offline. What eventually happened is the network would fork. And what happens in a fork is there's two sets of reputation, and the market basically trades them. So one set reflects reality, one doesn't. So the fork kind of relies on a tiny bit of the efficient market hypothesis. Markets should be able to detect what's reality and what isn't. If they can't, prediction markets don't work anyway. So it's something we're comfortable relying on.
When you say the network will fork, do you mean the Ethereum network?
No.
Okay.
So the reporting part of Augur would fork. So not Ethereum itself.
Okay.
So yeah, I guess I'm still stuck on the offline collusion thing. So what's the threat? So Augur you can think about as proof of stake almost in the way that oracles work. Is that roughly
a
good analogy?
Yeah.
Okay. So let's say there's 100 rep tokens outstanding, and there's some highly unlikely event like the Baltimore Orioles are going to win the World Series or something like that, right? There's like very strong odds stacked against it. So, and let's say there are a small number of people who are actually put up a bet that they will win it.
Right.
And ultimately it turns out that the Orioles win or whatever, right? And there's like this large payout that goes in their favor, but it's only a small number of people that are getting it. I guess, like, what is the threshold? Is it just the majority of oracles that have to vote for something? Because I can see on like r/Augur, basically, 90% of people are on the losing end of this bet, and they all just go and say like, hey, we should like vote like with 90% of our rep tokens like against that, basically.
Yeah. So the thing is like the only way like they would actually make money off that is if the amount of money they can make from that was worth like more than all their reputation combined. And so like, if that were true, then they could theoretically make money off it. But Augur kind of relies on that not being true. So if there's only like one market on Augur, and it's like has billions in volume and that's it, then Augur is not secure. But if there are multiple markets on Augur, then it is secure. So it does rely on there being, more than one large market on it. Because like say you were trying to collude, right? So you guys would lose like almost half of all the rep if you were on the losing side of that, like if your collusion failed. So you need to be able to make more than that in your bet to make it worthwhile.
I'm assuming like in Bitcoin or Ethereum, in like Augur rep terms, you can have like more than one wallet or like segregate your rep funds. Is that right?
Yep.
Okay. I guess, couldn't you just like, yeah, okay, I'll think a little more about that.
So just to make sure I understand, the rep and people reporting and voting are totally different, can be totally different than the people who are actually benefiting from the actual market.
That's right.
So in theory, you would have to, in a situation of collusion, those people would also have to have the other side of that bet. So both the reporters and rep plus the bet, which is like a big outlay of capital plus potentially you could, similar to Bitcoin, you could have miners who have nothing to do with the day-to-day like Bitcoin aspect, but they both have financial incentives for the network.
Yeah, that's exactly right.
Okay.
So you talk about UIs for decentralized apps. I know like Augur has a web app up today, but it's like it's test money. I mean, how are you building it today? Are you like going to continue doing it that way? And are you worried about getting shut down, like a backup plan, all that stuff?
Yeah, so it's like a web app, but it's all run client side besides like calls to the Ethereum network. And so if like the site got shut down or whatever, anyone could download it from GitHub. You could put it in like an Electron wrapper or whatever. Or anyone else could put the site up as well. So it's like something that's very easy to host because it's just like a static files, and that's it. And so like at launch, what we'll probably do is we'll put those static files on IPFS because there are like enough altruists to actually keep like a handful of static files up on IPFS. We just don't trust it for all the market data. And so if it were to go down, whether from like IPFS or like a government or something, the IPFS one's easy. You just upload it again and make sure people actually like seed it. For the government one, basically someone else would have to create another site or something.
And you guys are taking a small fee, I'm assuming, at launch. I guess like, how worried are you about the legal aspects of it? It's like,
yeah, so like we're but we're not like taking a cut directly. Like we own reputation, so we make money from that. As far as the legal aspect, I'm not like super worried because I've met with the regulators, and it's something that like it's a few years off from even approaching it. And when they do approach it, from what it looks like today, it looks like they'll approach things on the market creation side, because that's like the most logical point to regulate. So I'm not like super concerned about that at the moment. I think if we made like a for-profit making markets or something, then that's when you need to be more concerned about the regulatory side of things.
Is that why you guys say you're a platform for you're not creating them yourself? Is that like illegal?
What do you say?
You mentioned, I think, at the beginning that you're not a prediction market, you're a platform for creating prediction markets. Is that like a legal distinction you're trying to make for that purpose?
So yeah, it's both a legal distinction and a practical one. So like, there's never been a prediction market platform before. Like if you wanted to, make a bet on Betfair or list something on the New York Stock Exchange, there's a huge process you have to go through getting something listed or getting a new market added to Betfair. But on Augur, anyone can create a market. And then yeah, it's also a legal distinction because we ourselves are not creating any of the markets on Augur. And so the like legal stuff is like, it becomes a concern once you become like an operator from a legal standpoint. So like for instance, if we like stored everyone's private keys on like AWS, then we could be construed as an operator. If we created markets, we could be construed as an operator, things like that. So you want to avoid basically being an operator. You basically just want to be like contributors to open source code.
What happens in the case where reporters don't report?
Yeah, so if you're a reporter and you don't report, it used to be like the system would automatically like penalize you for it. Now it's like kind of lazy because we found out that would run into gas issues. So basically, like there'll be like UI would just automatically check this once in a while, client side, and check and see if anyone should have reported but didn't, and then it redistributes their rep to people who did. So it's basically like it basically just makes a call to Ethereum, which does this automatically, but the call has to be initiated by someone. Of course, there's like profit incentive to do that, so it's not like a big concern.
What if absolutely no one reported?
Yeah, so if like no one reported, then the markets would just like not resolve. They would just like sit there, and they'd just be like open for trading. It's like you could actually like get a large amount, probably the vast majority of the money out of the markets, because the way complete sets work is, I mentioned you can buy complete sets. You can also sell them. So there would like develop some like market where people would say, I have the losing outcome. You need it to be able to exit the market. So I'm not going to sell it to you for a tenth of a penny, but I'll sell it to you for a couple cents. Something like that would happen.
Will rep have a free-floating price on an exchange somewhere? So the idea is the quality of the reporting and reliability of it in the network. People will think that it's actually valuable to own.
Yeah, it'd be free floating basically. Yeah, it's a very like crypto economic reputation as opposed to a Amazon or eBay style reputation.
And then I think the follow-up to that would be then that would incentivize those who hold rep, thus the reporters, to not want to collude, because thus that would make rep less valuable because people would have less trust in the network.
Yeah, it's kind of like if you executed like if all you did was like get like a majority of mining power on Bitcoin and just executed 51% attacks all day, you'd probably destroy a lot of your own money doing so. It's kind of similar to that.
Can you talk about, so you mentioned that as a business you guys own rep and you can hypothetically sell that. Did you do that already? I guess like how have you funded the business to date? And then can you talk about like how the money supply, so to speak, of rep works, or like how that might work in the future?
Yeah, so for Augur itself, we funded it with a crowdfunding campaign that we did last year. We raised around $5 million in that. And then as far as like the market supply of rep, it's capped. There's like 11 million rep total, and that's basically it. And it's redistributed from people who don't report to those who do, and from people who report wrongly to those who report correctly. Yeah.
Does all of it exist right now? Is there like some like, release cycle over time, stuff like that? And then I guess like how much do you guys hold? So like how does that whole system work?
Yeah, there's not like a release cycle over time. Basically what we're going to do is we basically just like sent out an email and blog post and everything saying to submit your Ethereum address so that you can receive rep when it's out. And the idea is we want to have that ready to go as opposed to like doing it. It's like we don't want to finish Augur and have it ready to launch and then be like, okay, everybody, time to wait 2 months to have people submit their addresses. So we want to do that now. Once that's done, which like the deadline is like September 12th, then you would be able to trade it theoretically on wherever exchanges add it. What was the other question you had?
So
how much do we own, right?
How much do you own, and does it all exist at the moment? It sounds like it all exists at the moment.
It all exists at the moment.
Okay.
We own, so there's like 16 people in like the rep distribution, like the founder one. There's 16% in that, and there's 4% in the foundation itself. That's going to be like used for like things like bug bounties and like new hires and stuff.
So then the remaining 80% has already been sold, or like how does that?
Yeah, that was the part that was sold in the crowd sale.
Interesting. Okay.
How is the Forecast Foundation, or like basically how is Augur going to sustain its operations? Are you going to rely on the sort of like the cash flows that are generated by your rep, or?
Probably not. I mean, because that's like kind of like a legally precarious thing to do, at least in my opinion. So I mean, it has like 3 years of runway right now at like our current burn rate. So the idea is to get Augur launched, get it out there. And then after that, the idea would be like to build like for-profit ventures around it. And those would basically contribute to the open source code and maintain it, things like that.
So on one slide, you said like, since it's all on blockchain, there's no high frequency trading. Do people do miners or like people with relations to miners have an unfair advantage, or does that?
No, so the way that works is there's actually commit and reveal for trading as well. So you have to commit your trade ahead of time and then reveal it like a block later or whenever you want to reveal it. Because if you didn't do that, miners would have this huge advantage where they could basically, it'd be like front running we have today, but like insane, because you'd be able to front run like every trade on Augur super easily.
Yep. So you said you had 3,500 reporters today. Is that like on a test network, or is those the pre-sale buyers?
Yeah, that's pre-sale buyers.
And how would you get involved with being like a reporter? I see natural like businesses could potentially be built on being good reporters.
Yeah, so like to be a reporter, you basically have to like own reputation. So you buy it from someone, and then yeah, it's like as far as like businesses around that, I mean, you can make like a company that like provides like reports that are like, gives you all the answers ahead of time. Of course, there's a risk in that like you could make a mistake and then a bunch of people submit the wrong thing and lose a bunch of money from that. But that's like something someone could do.
Are you guys planning to try to help bootstrap the ecosystem around reporting? So given that you control a bunch of rep? Yeah,
so one thing we're working on is this thing called, it's called Argus. And the idea is you basically like, it's basically like a little AI that provides you like suggestions for reporting. So for things like financial markets, sporting events, things like that, it's very easy to get the results online and then just have you like check them. So like a lot of reporting could basically just be like a user making sure that this AI didn't screw up. But then for more obscure things, you need humans, because like the Russia invading a Baltic country thing, an AI is not going to be very good at answering that.
So are there like conflicts of interest if reporters are also trading, and are you trying to prevent that, or do you not see it as a problem?
So there's like a little bit there. For like the randomized reporting, you're selected randomly to report on stuff. So there's like a way higher probability that you would not get selected to report on something you traded in than not. There's a bit of conflict of interest there, but it's designed so that even if like all of the reporters were trading in all of the markets, you should still lose so much money from reporting wrongly, your reputation, that it wouldn't be worth it. Kind of in that sense, you lose it in two senses. You actually like lose the reputation to people who reported on the other side, and then you also like lose value, because if the reporters did like repeatedly report wrong on events, it would make reputation be basically worthless.
I see people talk about on the internet is people maybe making markets around various things, like someone dying and that being an incentive to kill them, make a lot of money that way. Is there a way for you to stop, or something built a system to sort of stop these kinds of markets?
Yeah, so reporters can report something that's like unethical. I suspect that like the only markets that would actually happen on would be things like assassination markets. And then I'm also not like too concerned about those, because I think that they're like a terrible from an economic incentive perspective. They're a terrible way to have somebody killed. Like it's kind of like a cop-out answer, but on Ethereum, there are ways you could make like contracts to make it so you could, incentivize killing people that would be way more effective than using something like Augur. So the problem still exists. It's just like not really a problem from our perspective.
So if you have a situation where you have randomized reporting and it's a really difficult contract to ascertain like one way or the other, right? So you give me very clear examples, like team beats other team in a sports game, stock price. Like, is Russia in control of Ukraine? Like, very vague, and you get picked to decide that. Like, how do you, as like, oh shit, I don't know anything about this?
Yeah, that's a good question. So you'd probably report indeterminate. There's a few reporting options. You can report, one of the actual outcomes that were listed in the market. You can report unethical, or you can report indeterminate. And so like markets like that one, like the Russia-Ukraine one, they should have like a very clearly specified resolution criteria. So it should be like, according to blah, 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 they'll say blah, blah, blah. And if that doesn't happen, then you would report no. If that doesn't even exist, like the resolution criteria is just gone, the market creator didn't add any, you would report indeterminate. So like it might cause some issues like early on in the system when market creators are just kind of lazy and create markets without a lot of specification. But once they start like losing money due to doing that, I think it'll fairly quickly correct.
And so the disincentive there is the market creator loses their initial creation if the vote ends up being indeterminate.
So they pay, when you create a market, you pay a bond basically, and if your market gets reported as indeterminate, you lose the bond.
So trying to understand the architecture, a little bit of it. So again, it's like a single page app, run through the browser, and then kind of, I guess, put in your seed or you can decrypt your wallet. And then does the browser talk directly to the Ethereum network? And kind of, is the heart of what you're building really like a smart contract Ethereum blockchain?
Yeah. So I mean, like that's basically all I work on is the Ethereum contracts themselves. It's like almost everything in Augur is basically just smart contracts on Ethereum. The UI is basically just an interface to them, because if you try to use them from the command line, it's like extremely difficult.
You don't have to run Jet for any laptop, do you?
No, you don't. I mean, you could, and it would use your local node. Otherwise, it would just like ping someone else's node.
Okay. And I guess like, I don't know, like how have you found developing those smart contracts? Like how many lines is it roughly? I mean, how many developers are working on it? Like I'm trying to get a sense of how to do that development.
Yeah. So I'm the only one working on the actual smart contracts. Like everybody else is on the UI and in the middle layer between like Ethereum, the JS API basically. So I think it's fairly easy. There are around 2,000 lines of code of business logic, and then if you count like the data getters and setters, there's around 3,000 lines of that. The business logic used to be like 5,000 lines, but we've been like super focused on making it way simpler. So I think you can actually get like quite a bit done in relatively few lines of code on Ethereum.
And like, how long did you get the speed on that? And like, what was the best resource you learned how to write smart contracts?
Yeah, so when I started, there's like two languages to write smart contracts with on Ethereum. There's Serpent and there's Solidity. When I started, Serpent was the only one that existed. So I used that. There was like maybe a few page Wikipedia article on it that Vitalik wrote. And since then, like Cornell published a paper that's like a programmer's guide to using Serpent. That's pretty good. I would check that out. And then nowadays, Solidity is more popular. It's like the one they've marketed more. It has more documentation. I'm not as big a fan of Solidity though, because I think it adds more complexity. There's a lot more features to it. And like, I mean, like I think the DAO thing wouldn't have happened if Solidity had better documentation or simpler structures in it. Because the mechanism that caused the DAO failure was they used call.value, which sends all the gas in one contract to another, which allows it to basically make other calls that it shouldn't be able to do. And the Solidity documentation basically said that this was secure, it was fine, there's no issue there. And so I think like even the creator of Solidity didn't notice that flaw. And so like when it starts getting more and more complicated, it becomes harder to reason about the code. So I like Serpent for those reasons because it's super simple. It's like, you know, if statements, else statements, while loops. There's one type, it's integer 256, and that's about it.
When will Augur be live?
So I don't have a good answer for that. I mean, we want to start security audits soon. Right now, I've just been doing some stuff that I want to get done before we start audits. So like rewriting parts of the code base to comply with all like the JPL guidelines and the automobile guidelines for like writing safe code. I'd rather do that now than after audits because I might introduce some bugs doing that. So we should be starting audits relatively soon. So then after that, the thing that would kind of cause launch to be delayed would be dependent on progress on the UI, which is harder to predict.
So is that like a year from now?
We're aiming for like around the election, but it wouldn't surprise me if we overshoot it at all.
I'm curious, what kind of things do you do differently if you're trying to write like super secure code?
Basically it's like I read after the DAO attack. I read all the like JPL guidelines and the MISRA CD guidelines. Maybe like 50 to 60% of it is applicable in general, and the other 40% is like applicable to Java or C, depending on which one you read. It's almost all common sense stuff. It's like don't use recursion because you don't want to add any complexity. You want it to be like super simple, like someone who's taken like one programming class should be able to understand your code and know what it's doing. And if they can't, there's probably a decent chance it doesn't meet the MISRA C branches because they're designed to be like that simple so that if there is a flaw, it should like pop out at you and be obvious. Like some of the things are like, don't have very many if-else branches, you know, keep your code simple. Don't have too many parameters, don't have too many return values, things like that.
What can we do to help?
I don't know. Yeah, that's cool. Yeah, it'd be great if you guys like launched a stablecoin or something, but
Stablecoin?
Yeah.
How would that help you?
So I mean, like, say you're speculating on something on Augur. You know, say you're a Chinese national and you bought like fake Apple shares. And Bitcoin is like $600. Apple goes up to 120, Bitcoin goes down to 500, and you lost money even though you made the right trade. So I think for long-term like mass adoption, you really kind of need stable coins on a platform like this.
And then I noticed like rep trader r/rep trader looks pretty basic.
Yeah.
In terms of like people saying want to buy, want to sell, like rep. Is that something that you anticipate being supported on exchanges?
Yeah. So I wrote a contract like a couple weeks ago that fits like the Ethereum token API that will allow you to trade rep. And so then we announced that like submit your Ethereum address. So the deadline for that is September 12th. And so after that, it should be like available for any exchange that wants to use it. It's basically just like the standard Ethereum token API, which allows you to like transfer funds and approve someone else to transfer on your behalf. And at that point, any exchange will be able to add it. One thing that I'm not sure how exchanges would handle though is like when you're doing a transaction on Ethereum, you do have to pay like gas fees. I don't know if they would like, I don't know how they would account for that. I don't think there are like really any tokens that are on exchanges yet. I mean, there's Ether, but the gas is paid in Ether, so it doesn't matter as much.
So I know the DAO tokens are on Poloniex, and the way they handle gas fees is basically users that own DAO tokens transfer those tokens to the exchange wallet. So they pay the gas fees to get it to the exchange, and then the exchange of Ethereum token API tokens is done off-chain. So there's no gas costs involved. You just, yeah.
And then does the exchange pay when you withdraw, or?
I'm not sure. Yeah.
That makes sense.
You mentioned that you crowdfunded $5 million, I think. And I was just wondering if that seems to be like more and more common. People are doing that. But did you guys talk to any? Like, I guess I'm just worried like the SEC is going to do it as unregistered securities or something, and then it might create trouble for people who are doing that. But it seems to keep happening more and more. So have you got any like legal opinions on that give you confidence?
Yeah, so our law firm is Pillsbury Winthrop, and I mean, basically, like what they've told us is that, so I mean, there's like a few like rules for testing whether something's a security. There's the Howey rule, which is like a really old one that like everyone uses as a standard, and there's a bunch of other case law you can look at too. And anyway, kind of what they found out is that it'd be very difficult to say that like rep was a security because if you don't like report on it, you don't get anything, and you actually lose it if you don't report. So it's like you know, the government agency can say that something's something, you know, using some obscure law if they wanted to, right? But in practice, from like what they know, rep doesn't seem to be a security for like those reasons because there's no other security in the world where if you don't use it, it actually gets taken from you. And there's none where it actually like requires you to do work. I mean, you have like, if you own a security, you vote in like shareholder meetings, but you don't have to do that. Whereas with Augur, if you don't do that, it kind of goes away.
How long an advantage do reporters have before they know they need to report on it?
So the reporting periods are like they're every 2 months, and it used to use like block numbers to do that, but that's like a terrible idea because there's so much variance in those. So now it just uses timestamps. So it's just like fairly regular, like you would just know, you know, sometime in June I need to get on and check and see what I have to report on, and you would know like at the beginning of the month, and then you have until the end of the month to submit your commit, and then you have the entire next month to submit your reveal, and then at the end of that, it's done and it's resolved.
Let's say I go to Jamaica for 6 months just because. What happens in that case?
So I mean, you could like join like a reporting pool or something. You could, you know, sell your rep, or you could like make it dormant where you don't get any fees or anything, but don't have to report.
All right, we're out of time, but thanks for coming in. That was really cool.
Yeah, thanks for having me.
Thanks for doing that. Okay, so what's the easiest way to invest in this? Your own easy website.